Government debt can sound unreal because the numbers are so large that they stop feeling connected to daily life. But government debt matters because it affects interest payments, taxes, public services, inflation risk, investor confidence, and the choices future governments can make when a crisis arrives. Government debt is money a government has borrowed and not yet repaid. It usually borrows by issuing bonds. Investors, banks, pension funds, foreign governments, and citizens may buy those bonds. In return, the government promises to pay interest and repay the principal at a future date. Governments borrow for many reasons. They may build roads, fund schools, respond to wars, support people during recessions, or cover spending that exceeds tax revenue. Borrowing is not automatically irresponsible. It can spread the cost of long-term investments or emergencies across time. A deficit and debt are different. A deficit is the gap in 1 year when spending is higher than revenue. Debt is the accumulation of past borrowing that has not been repaid. If a household spends more than it earns this month, that is like a deficit. The credit card balance that remains is like debt. The first practical issue is interest. Debt requires payments. If the debt is large or interest rates rise, more of the budget goes toward interest instead of services, infrastructure, or tax relief. A country can still function, but the room for new choices becomes narrower. Debt is often judged relative to the size of the economy. A large debt in a large, productive economy may be easier to manage than a smaller debt in a weak economy. Debt to GDP compares what the government owes with the economy's annual output. The ratio gives context that the raw number cannot. Debt is riskier when a government borrows in a currency it cannot create. A country that owes foreign currency debt may struggle if its own currency falls. The debt becomes more expensive in local terms. Countries borrowing in their own currency have more flexibility, but that does not remove all risk. Investor trust matters. If lenders believe a government can repay, they may accept lower interest rates. If they fear default, inflation, or political chaos, they demand higher rates or stop lending. Trust can change borrowing costs quickly, especially for countries already seen as fragile. Growth helps manage debt. If the economy grows faster than the interest cost, the debt burden may become easier to carry over time. If growth is weak and interest costs rise, the burden becomes heavier. That is why productivity, employment, and investment matter in debt discussions. Some people think governments can solve debt by printing money. In limited situations, central banks can support markets, but creating too much money to cover spending can damage trust and raise inflation. Inflation may reduce the real value of debt, but it also reduces purchasing power and can hurt households badly. Reducing debt can involve tax increases, spending cuts, faster growth, or some combination. Spending cuts can reduce deficits, but they may also hurt public services or slow the economy if done during weak conditions. Tax increases can raise revenue, but they can also affect investment and household spending. Some debt can be productive. Borrowing to build ports, electricity systems, schools, or digital infrastructure may raise future income. The key question is whether borrowed money increases the country's capacity or merely covers current spending without improving future ability to pay. Debt becomes more dangerous when it funds waste, corruption, repeated short-term promises, or interest on older debt without solving the underlying budget problem. In that case, borrowing does not build capacity. It simply pushes today's cost into tomorrow's budget. A household analogy helps but has limits. A family cannot tax the economy, issue national currency, or influence interest rates the way a government can. Still, the basic pressure is familiar. Borrowing can help in a crisis or investment, but permanent borrowing for routine spending eventually reduces flexibility. Debt matters most during crises. A government with manageable debt can borrow quickly to support banks, jobs, hospitals, or disaster recovery. A government already under stress may have fewer options or face higher borrowing costs exactly when it needs help most. People often say debt burdens future generations. That can be true if future taxpayers inherit interest costs without receiving benefits. But if the debt built useful infrastructure, education, or stability, future generations may also inherit assets. The fairness question depends on what the borrowing was used for. Politics makes debt harder to discuss honestly. Spending is popular when people receive benefits. Tax increases and cuts are unpopular when costs become visible. Governments may delay hard choices, especially when voters reward short-term relief more than long-term balance. Warning signs include rising interest payments, repeated deficits during good economic times, weak growth, loss of investor confidence, heavy foreign currency borrowing, and political refusal to adjust. No single number tells the whole story, but these signs show when debt is becoming less manageable. Government debt matters because it shapes future choices. It is not automatically a disaster, and it is not automatically harmless. The important questions are why the money was borrowed, what it produced, how expensive it is to service, and whether the economy can grow enough to support it. A useful way to think about government debt is to compare two different uses of borrowing. Debt used to build transport, schools, energy systems, or emergency capacity may support future growth. Debt used only to cover repeated shortfalls without fixing the cause can leave future taxpayers paying interest without receiving much lasting benefit. Interest costs are the part people often overlook. A country may borrow comfortably when rates are low, but if rates rise, refinancing old debt becomes more expensive. Money that could have gone to services, infrastructure, or tax relief may instead go to bondholders. The debt level matters, but the interest bill matters too. Trust is another key factor. Investors lend to governments when they believe repayment is likely and the currency will remain credible. If that trust weakens, lenders may demand higher interest or avoid the debt altogether. The financial problem can then become political, because confidence is hard to rebuild quickly. The same debt number can also mean different things in different economies. A growing country with trusted institutions, productive investment, and stable borrowing costs can carry debt differently from a country with weak growth and rising interest. Context does not make debt harmless, but it changes how serious the pressure becomes. Debt also limits choices during a crisis. A government with manageable debt may respond to a recession, war, disaster, or pandemic with more room to act. A government already stretched may still borrow, but every new promise becomes more expensive and more controversial. Debt matters most when flexibility is needed. A simple household comparison helps, but only up to a point. Borrowing for a tool that raises future income is different from borrowing every month to cover the same gap. Governments face a larger and more complex version of that difference, because the bill is spread across taxpayers, investors, and future budgets. A country can carry debt for a long time if trust, growth, and discipline remain strong. But debt removes comfort when interest costs rise or crises arrive. The best way to judge government debt is not panic or dismissal. It is to ask whether borrowing is building future strength or quietly shrinking future options.